Welcome to the deep dive. Our mission today, well, it's a shortcut to strategic insight. We're diving deep into Ather Energy's Q2 FY26 performance. They're one of India's leading electric two-wheeler makers.
Yeah, and we've got the financials, the press release, the earnings call transcript, the whole package.
Exactly. And we want to synthesize how a company manages record scale, conquering new geography, and fundamentally repairing its path to profitability, all in just one quarter.
It's fascinating, isn't it? Because this isn't just a growth story. It's about maturation. These sources show Ather executing, well, frankly, the hardest trick in the book. Scaling up volume while also aggressively fixing the cost structure.
That's a tough balancing act.
It really is.
Yeah.
If they pull this off, they shift from being sort of a niche tech player to a real mainstream giant.
Okay, that's the thread we're following, and the headlines certainly scream scale. Highest ever quarterly revenue, what was it, 940.7 crore?
That's the one. Huge number for them.
And market share jumped substantially, up to 17.4%. So, okay, let's unpack how they actually managed that expansion and, crucially, how they funded it. Let's kick off with the raw numbers for Q2 fiscal 26. Total income, like I said, soared to 940.7 crore. That's up 57% year on year.
And 40% quarter on quarter. Just massive acceleration.
Yeah, and it's the volume growth that's really fueling it. They sold 65,595 units. That's a stunning 67% increase compared to last year.
And the scale, you see it directly hitting their financial health. We see major improvements in, well, two really crucial profitability metrics.
Okay, what are they?
First, the adjusted gross margin, or AGM. It hit 22%. That's a solid 300 basis points improvement year on year.
And that's not just luck, right?
No, it's down to deliberate value engineering, getting the product mix right, and importantly, that growing non-vehicle revenue stream, software, charging, accessories.
Right, and the second metric?
Even more impressive, maybe, is the EBITDA. It improved by a massive 1,100 basis points year on year. They managed to narrow their operating losses down to 90.7 crore.
Wow, 1,100 basis points. That's 11 percentage points sliced off the loss margin, basically.
Exactly. It means they slashed the proportion of revenue eaten up by core operating costs. And this is the first time they've actually touched single-digit negative EBITDA, landing at negative 10%.
Okay, single-digit losses. That sounds good. But hang on, there was this mention of a subsidy deferral. Management talked about a one-time issue, a rare earth supply crunch.
Ah, yes. That's the nuance.
They had to defer about, what, 192 million in subsidy claims? Doesn't that kind of, I don't know, muddy the waters? Claiming profitability progress but excluding a real cost.
That's the critical point they had to tackle on the earnings call. And look, their argument is that the rare earth crunch was a genuine one-off operational hit. It distorted the reported numbers for that quarter.
Okay.
But here's why their claim of fundamental improvement, I think, hold up. Even if you strip out that entire incentive deferral, their underlying gross margins were still 21%.
Right.
And that figure is a phenomenal 900 basis point improvement year on year.
Ah, okay. So the underlying business, the core operation, is healthier regardless of that temporary accounting hiccup.
Precisely. That fundamental health is coming from, well, two things we touched on. That value engineering, constantly tweaking the product to make it cheaper to build.
And battery mix.
Exactly. The increasing share of LFP batteries in their mix, LFP, lithium iron phosphate, generally lower cost, safer, maybe a bit heavier, but it helps them cut input costs and critically de-risk their supply chain.
Which we saw was important with that rare earth issue.
Definitely. And it brings us back to that integrated business model. Their non-vehicle revenue software subscriptions, charging, all that it shipped in, a healthy 12% of total income this quarter.
It really proves they're selling an experience, an ecosystem, not just, a scooter.
That's the sticky revenue investors love to see, especially in a hardware company. It builds resilience.
Okay, so that improving margin story gives them the cash and I guess the confidence to really execute the big play distribution.
Yeah, because all that scale doesn't mean much if you can't sell the product outside your comfort zone, your early adopter base.
And the numbers show they did. Market share jumped from 12.1% year ago to 17.4% now, driven by just a frantic pace of expansion, adding 78 new experience centers just in Q2.
It's that strategic pivot into the middle states that's really huge here. South India, yeah, that's still their bedrock. They hold about 25% market share there.
Still dominant in the South?
Absolutely. But the new growth engine is clearly Middle India, states like Gujarat, MP, Maharashtra. That region is their fastest growing, surging to 14.6% market share, up from just 8.8% a year ago.
They specifically called out Madhya Pradesh, didn't they, as an outstanding story?
They did. Apparently, it went from just a few hundred units a month last year to now over 2,000 units monthly. That's massive growth. And they hit mid-teens market share there, too.
Okay, but opening 78 new centers, that sounds expensive. It could easily drain capital, hurt those margins we just talked about if the stores don't start selling effectively, like, right away. How quickly are these new dealerships actually maturing?
Now, that's the really interesting strategic insight kind of buried in the earnings call transcript. The key nugget is that average selling prices, ASPs, have stayed, and I quote, extremely steady, even in these brand new markets.
Extremely steady, even with all the new stores. How?
It suggests they've built a repeatable, predictable playbook. They talk about this three-tier opportunity funnel that seems to standardize how revenue builds up, even in totally new territory.
Okay, a three-tier funnel. Let's walk through that. What's tier one?
Tier 1 is the Pro Pack attach rate. Basically, how many new customers opt for the premium software subscription. They said in MP, for example, it went from maybe 45–50% initially to 70–75% within a few quarters as the store matured.
So people quickly buy into the software ecosystem. Okay, tier two.
Tier 2. The base vehicle ASPs rise. As the dealers get more confident, they get better at selling the higher-end variants, not just the entry-level models.
Right, moving customers up the value chain. And tier three.
Tier 3 is accessories.
Yeah.
The attach rate for things like helmets, guards, maybe merchandise. They mentioned Gujarat's accessory rates jump from around 60% to 75%. And management basically said it takes about 3 to 4 quarters for a new store to hit stable profitability because of this predictable curve.
That's actually quite powerful. It makes the expansion feel less like a gamble and more like replicating a successful factory setup, but for sales.
Exactly. It's a repeatable process.
Okay, so they've got the financials improving, the distribution expanding methodically. Now let's shift to the technology, maybe the softer side, the psychological side of sales, because that seems crucial for moving beyond early adopters to the real mainstream buyer.
Absolutely critical. And the tech rollout seems geared towards providing comfort and reducing friction. Ather 7.0 rolled out with new features.
Yeah, things like pothole alerts, crash alerts, voice commands. Did those actually get traction?
Apparently, yes. Very strong consumer feedback, according to them. And the adoption rate for the whole AtherStack Pro ecosystem is strong evidence. 89% of customers opt in.
Which feeds right back into that non-vehicle revenue stream we talked about. It's a virtuous cycle.
It is. And on the physical side, the charging infrastructure keeps growing. The Ather grid is now over 4,300 fast charging points. Globally, too, India, Nepal, Sri Lanka.
And they launched a new charger.
Yeah, a next-gen 6-kilowatt charger, supposedly twice as fast. Give you about 30 kilometers of range in just 10 minutes of charging. That helps tackle the charging anxiety piece.
Okay, so faster charging helps. What about range anxiety itself? That's always the big one for EVs.
Well, their new product strategy seems explicitly designed to counter that. They launched higher range options for both the 450S and the Rizda S models, pushing the certified range up to about 160 kilometers.
Filling a gap, basically.
Exactly. They called it the low-tech, high-range customer segment. People who prioritize distance over maybe all the bells and whistles of connectivity.
Makes sense for a mainstream buyer, but how do you convince someone who's maybe used to a simple, cheap petrol scooter to make the jump to a, let's face it, more expensive EV? Especially with battery life concerns.
Right. So they introduced two specific financial or maybe psychological comfort levers. First, battery as a service, or BOSS.
Right. That lowers the upfront price significantly. The Rizda S could be as low as, what, $76,000 with BOSS?
Yeah, it makes the initial sticker shock much lower.
Yeah.
And second, they launched a specific buyback program.
Okay, but the earnings call suggested the actual take-up rate for BOSS and buyback is pretty low. Like low single digits.
That's right. It's low. So you might ask, why even bother?
Yeah, why implement them if hardly anyone uses them?
Because according to management, their main job isn't actually maximizing attach rates. It's about providing comfort. They're psychological tools.
Ah, interesting. So they act as signals.
Precisely. They signal that Ather stands behind the long-term value of the battery and the vehicle itself. It tackles that fear about resale value or massive battery replacement costs down the line. It offers social proof, reassurance.
So it's less about the direct financial impact of the programs themselves and more about overcoming that core mainstream anxiety barrier. That's actually a pretty clever, subtle strategy.
It's a key pivot, I think. They're solving an emotional barrier, not just a purely financial one.
Okay, fascinating. Let's look ahead then. What's coming next?
They unveiled something new, right? The EL platform?
Yes, that was the big reveal for the future. The EL platform is their new foundational scooter platform. It's designed to be versatile, scalable, and crucially built for better cost structures, launching next year.
And focused on mass market needs like safety and convenience.
That seems to be the core idea. It sounds like a complete overhaul underneath. Some key features they mentioned. Ather's first 14-inch wheel, which should offer better stability, especially for riders maybe less comfortable on scooters. Okay, larger wheels are usually better for ride quality. What else?
This integrated Ather charge drive controller, it combines the AC and DC converters. Apparently, this simplifies servicing, makes assembly easier, and big one enables onboard charging.
Onboard charging, meaning you don't need the bulky brick charger.
Exactly. The customer just carries a smaller, lighter, portable cable, making it way more convenient.
That is a convenience win. And safety.
They're introducing their own proprietary advanced electronic braking system, AEBS. They claim it mimics the performance of ABS anti-lock braking system, but at a much lower cost.
Bringing advanced safety down to a more accessible price point? Very smart if it works as advertised.
It fits that mass market focus perfectly.
So how does all this fit into the broader industry picture? Did the CEO give any sense of overall market health?
He did make some interesting comments. He noted that even with headwinds, remember that petrol GST cut that made petrol momentarily cheaper, and the rare earth crisis we discussed, the EV two-wheeler industry, still showed strong resilience and growth. The market itself seems to be maturing.
And the reason people are buying EVs, has that changed?
According to him, yes, fundamentally. He stated pretty clearly that the main driver is no longer a June. Total cost of ownership, TCO.
Really? Not the saving money on fuel argument anymore.
Apparently not as the primary driver. He said it shifted purely to product and aspiration. People want the better technology, the better ride, the cool factor.
Wow, that is a massive shift.
It really is. It suggests the EV space, at least in their view, has moved past the stage where you need a spreadsheet to justify the purchase. It's become more of an emotional, aspirational buy. TCO is now, as he put it, sort of a post-purchase rationalization. The bonus benefit.
And Ather's strategy seems to reflect that. They
Right.
mention maintaining an anti-discounting stance.
Yeah, they're pretty firm on that. They argue heavy discounting just spoils the residual value for everyone and hurts the brand. They want growth, but quality growth focused on segments above that Euro-LAC price point. They don't want to just push cheap volume.
Maintain the aspiration, maintain the value.
Exactly. And just tying back quickly to the LFP batteries we mentioned earlier.
Yes.
They confirmed it's not just about cost cutting. It's a core strategic move to de-risk their supply chain. By using different battery chemistries like LFP alongside NMC, they can source from multiple geographies, multiple vendors.
Making them less vulnerable to the next supply shock, like that rare earth crunch.
Precisely. Building resilience into the system.
Okay, so let's try and wrap this up. To summarize this deep dive into Ather's Q2 FY26, the story really seems to be one of rapid but quite intentional operational maturity.
Yeah, I think that's fair.
They stabilized the financials, improved those fundamental margins despite some supply chain noise. They successfully pushed into new territory, Middle India, using what looks like a repeatable distribution playbook.
Check.
And they're clearly laying the tech groundwork for the next big phase, AtherStack 7.0 upgrades now, and the upcoming EL platform designed squarely for that mainstream customer.
That sums it up nicely. They're hitting scale, improving margins, expanding reach, and prepping the next generation of product. It's quite a coordinated effort.
So maybe the final provocative thought for you, the listener, is this. Ather seems to be successfully making that tricky transition from an early adopter market like South India to a more mainstream market like Middle India.
And they're doing it not just with product, but by focusing heavily on distribution, on software, and on actively alleviating those core customer fears using tools like BOSS and Buyback, even if uptake is low.
So does this signal that the EV two-wheeler industry in India, or at least players like Ather, are finally crossing that chasm, moving from being a tech novelty to becoming a dominant mainstream choice?
And maybe what stands out to you about how they're choosing to tackle that mainstream customer anxiety? Is it the tech, the financing tricks, the distribution push? Something to think about.
Definitely food for thought. Thanks for joining us for the deep dive. We'll see you next time.